Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is May 13th, Monday. Hope you are having a great week. Your week is off to a great start. Today we're going to take a look at one that was suggested by a subscriber. I believe he's a subscriber to the channel, Visa. This is out of the financial sector. Let's jump right in. And if you are new to the channel or you just like to take a moment and help me out, if you could hit that thumbs up button down below. Hit the subscribe button. Make sure that subscribe button is clicked. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you think of the video. And if you have any companies like Visa you'd like me to cover in a stock pick of the day video, go ahead and drop those down below as well. Doing all that really does help out a small YouTube channel like mine grow. It helps to get these videos out to more people, and share the videos. If you know anyone who's an investor or might enjoy the videos, go ahead and share with them as well. That's another way to help the channel out, and really do appreciate everyone who's taking the time to do that. It doesn't cost you anything except a couple seconds, so thank you so much. Now, this is the Vested Interest stock screener. This is how I set up the videos, the stock pick of the day videos. So we're going to run through this screener. At the end, I'll show you how it shakes out, whether it meets 5 of 8 or 6 of 9. And if it does, typically a company will go on my watch list. Then I'll do more of a deep dive into it, figure out a price I'm willing to pay by doing a discounted cash flow analysis, and then wait for the stock price to align with that price or in that vicinity. You can pause this. You can use this screener, just adjust it and tweak it to your investing strategy. This is set up for mine, so maybe there may be some you want to add, there may be some you want to take away. This is just what I've set up for my screener, and again, how we run through these videos. Now, back to the main meat of the video here, back to Visa. If you want to know more about this company, check them out at usa.visa.com. That's usa.visa.com. That is their homepage where I pulled this information from. Pioneering payment technology. Our journey begins in 1958, the year that Bank of America, that's right, they were once part of Bank of America, launched the first consumer credit card program in the U.S. We expanded internationally in 1974 and introduced the debit card in 1975. In 2007, regional businesses around the world were merged to form Visa Inc. And in 2008, the company went public in one of the largest IPOs in history. Today, we operate in more than 200 countries and territories with products and services available on cards, laptops, tablets, mobile devices, and more. We continue to evolve, but our purpose remains the same: to uplift everyone everywhere by beginning the best way to pay and be paid. And that's really what their focus is on. All that to tell you what they really focus on: to pay and be paid. They are a payment service, right? Whether it's credit cards, whether they're online services, they are transferring money from the person paying to the person being paid, and that's what they're involved with, the transfer of those funds, right? So they have an IT touch, they have a financial touch, and those things more and more are becoming merged where it's just data transfers, right? Bank of America in 1958, they started out as Bank AmeriCard, Visa, the company, in 76, and then meet Visa Inc. Visa forms a global corporation while Visa Europe remains member owned, right? Now, we're going to continue on. So that gives you a little overview of what Visa is. You may have them in your purse or your wallet, right, as one of the credit cards that you use. I think we have American Express. I don't know. Do we have Visa? I think we might have a Visa as well. No, we have a MasterCard and American Express. I'd have to look. No, we have a Visa. I think the Costco card is a Visa. So the reason we're taking a look at them, down 0.48%, not a huge drop, but I'll be honest with you, I've been trying to do this for a little over a week now. It's hard to catch Visa on a day they've been down. They have been up significantly over the last couple of weeks. So this is one of those days I'm going to catch them, a 0.48% drop on the day. Closed out the day at $279.39. We are talking about Visa Incorporated, ticker V, again out of the financial sector. Looks like they're down a little bit more in the after hours. 52-week range as low as $216.14, as high as $290.96. Definitely closer to their 52-week high than their 52-week low. Market cap of 571.67 billion market cap. A beta of 0.95, so just a little less volatile than the overall market. Price to earnings ratio, PE ratio, $31.29 per share. That's a little elevated for me, but I feel like this is one of those companies that's always trading at a premium. Earnings per share, EPS, $8.93 per share. Earnings date coming up July 23rd through July 29th. Forward dividend, $2.08. That's quarterly, so divide by 4, though we'll see that here in a minute. Very low starting dividend yield, 0.74%. Ex-dividend date, May 16th. So that is coming up this week. If you were to buy them now, you would be in line for the next dividend. 1-year target estimate, at least according to Yahoo Finance, they see a little bit of upside, $307.44 over the next year. Now we're going to take a look at dividend yield theory, see if this one is potentially showing in the undervaluation. To do that, we look here at the 5-year dividend yield average, 0.65%. We compare that to the 0.74% that they're currently at, right there, or forward annual dividend yield, same number, 0.74%. And since it is higher, that speaks to some potential undervaluation. Not a whole lot of margin of safety, but it does speak to some potential undervaluation where they currently sit. Very low payout ratio here, 21.7%. So hopefully they are growing their dividend very fast, and they need to continue to do that and build out this yield a little bit, because they have a lot of room to do so, right? Ex-dividend date was the 16th. They are going to pay out on June 3rd. Now, price to book. We're going to take a look at price to book because it's a financial company. You want to compare it to other companies, like American Express, like MasterCard. I don't know that you'd want to use the regular price to book that you'd use for banks. If you used what you use for banks, you just go a 1 being fair value, anything under 1 being undervalued, anything over 1 being overvalued. But in this case, that's not really going to work. Their price to book is sitting at $14.54, $14.54. Now, I will say, if you go and you look back in time, that's current. If you go back and look in time, March, it was a little lower at 14.37, but still in the 14 range. All of 2023, it would have been a better buy. 12.8%, 12.81, 12.2, 13.8. So if you go just by price to book, they are starting to get a little pricey based on their own historic over the last year, right? They would have been a much better buy back here at 12.2, 12.8, 12.81, right? These would have been better times. You would have got them cheaper back here. You get up in the, just looking at their overall price to book, you can kind of give yourself a gauge of where they at. Are they expensive right now, or are they cheap right now? Based on the last year, they are at the expensive, at least according to price to book, expensive portion of their run, so to speak. Now let's take a look at, that's another way to use price to book, right? You can see if they're over the last year, are they expensive right now, or are they cheap? I mean, if they were back here down at like 12.6, 12.2, 11 or something, then they'd look cheap compared to their last year. Now we're going to look at free cash flow. We want growing free cash flow over time because dividends are paid out of free cash flow, and we want growing dividends. And typically if you have growing dividends, you have growing free cash flow to go along with it. And I think I said that backwards. Typically if you have growing free cash flow, you have growing dividends to go along with it. Going back to 2020, you can see here $9.7 billion, 2021 $14.5, 2022 $17.8, 2023 $19.6. Steady free cash flow growth. Very nice to see. They are repurchasing their own shares as well. Very nice to see that as well. Overall, as far as free cash flow grows, this is exactly what you want to see, right? 9.7 billion, 14.5, 17, 19, nice steady growth over time, as well as, like I said, repurchasing their own shares. And it looks like they've increased it over the last couple years, their repurchase of their own shares. Now we're going to jump over to stockanalysis.com. This is another site that I like. You pick any sites that you like or you prefer. You don't have to use these two. Just make sure you're not just blindly looking at one. Look at 2, if not 3, possibly 4 sites to make sure the information you're getting is accurate and up to date. A lot of times different sites present information in a different way. Some sites easier to understand, some sites not so easy to understand, and some sites go back, like stockanalysis.com. That's part of the reason I like them. They go back almost 10 years, right? So I like that. Now we're going to jump here and take a look at the 26 analysts that have taken a look at this. They call it a consensus buy, and if you were to go to stockanalysis.com, you could click on each one of these. This would be a strong sell, a hold, a buy, a strong buy, and you'd be able to tell out of the 26 analysts where each, how many fall in each category. They have a low estimate of $252. That would be a 9.85% decrease from where it currently sits. Obviously, that would be a better price to buy in at. Average estimate of $303.38. That would be a 8.53% increase. And a high estimate, and that's pretty close to what we saw with Yahoo Finance on the previous page, and a high estimate of $335. That would be a 19.84% increase from where it sits. All the while, you could collect that 0.7% dividend yield. Now, I like to jump into statistics here, look at return on equity and return on invested capital, see how well the company is reinvesting its capital back into itself. And as you can see here, excuse me, 46.6% return on equity. I like 10% or better, smoking high. And same thing for return on invested capital. I like 10% or better. They're at 29%. Very good use of their capital and their funds reinvesting back into the company. EPS growth, I like 5% or better. You can see here they're forecasted at 15.99%. Very good number, over 3% what I'm looking for, or 3%, 3 times higher than what I'm looking for, not 3%, 3 times. And then we'll jump back over to the dividend. As you can see, quarterly dividend payout ratio, I think Yahoo Finance had it at 21. They're saying 23. Again, I like 75% or lower, so this is very low. Anything under 50% is extremely low. Very high dividend growth, 16.52%, so double-digit dividend growth, very nice, and you want that with such a low payout ratio. You want double-digit dividend growth, right? 0.75% dividend payout is not very big. 16 years of growth. Buyback yield 2.34%, shareholder yield 3.08%. That's what you want to see. You want to see that buybacks, since they are buying back their shares, you want that to be a positive yield. And you want your shareholder yield overall to be positive. Very good numbers overall. The only thing I don't like is where this one is priced at right now. Price to book has them a little high. Their overall price pretty close to their 52-week high. And if you think we are heading into a recession and credit card debt is up right now, which it is, you should be a little worried that people are going to forego paying off credit cards and let them go, into collections if we end up having a prolonged recession. So whether or not you buy a company like this, you should understand where you are in the market, what cycle of the market we're in, right? We're probably past the fast growth where a lot of people were using credit cards. We're probably starting into a downturn, possible recession. And if you are in there with a lot of people with a lot of credit card debt, right? Are you going to pay your mortgage, or are you going to pay your credit card? Are you going to pay for your car note or your credit card? Are you going to pay your utility bill or your credit card? That's how I look at companies like this. I don't own any credit cards. American Express is one that I'm looking at, but right now I'm not looking to buy because I want to wait and see how the next 6 to 9 months shakes out. And if we enter a recession, I think you're going to get a lot of these companies a lot cheaper. Just my 2 cents there. 2021, you can see they were paying 37 cents. Jumped it up in November 2022 to 45 cents. And what was that? 45 cents. And then again, November 2023 up to 52 cents. So very nice dividend growth overall. They do pay out on that March, June, September, December timeframe. I want them a little cheaper if I was going to buy them, but I know a lot of people are buying Visa right now. And I think a lot of it, people are seeing that they ran up and people get excited, think they're going to miss out. But I think there's going to be cheaper opportunities on Visa if we hit recession, and on other credit cards if we hit recession. Because like I said, you'll probably have a lot more people that go into credit card collections at that point. Well, what's it look like on the screener? All right, we understand the business, check there. Growing free cash flow, definitely a check there. Growing dividend, definitely a check there. Double-digit growth. Dividend payout ratio, 75%. Yep, check there. Check valuation based on dividend yield theory. Dividend yield theory says it's potentially undervalued. Check there. Return on invested, no, it's not within 15% of a 52-week low. No check there. Return on invested capital, return on equity, 10% or better. Yep, check there. Earnings per share growth greater to the industry or 5% plus. Check there. It was not under 1 for price to book, and as a matter of fact, it is not really in line with its peers either. I did look up MasterCard's price to book. They were at 58.65. American Express was at 6. So American Express, just by price to book, is much cheaper, half as cheap as Visa is right now. And MasterCard, if you go by price to book, is very, very expensive. So I don't know that I'd use price to book for these particular companies because that's a wide spread. 6 for American Express, 14 for Visa, and 58.65 from MasterCard Express. I don't know what you can really garner from price to book from these ones, but I don't know that I'd use it. And so it does meet 5 of 8, even meets 6 of 9 for financials. So this would potentially make it on my watch list. Well, that is really it for this video. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like a Visa that you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. Hey, I'm not a financial advisor. You can read through the rest of this, but this presentation is not financial advice.